I want to get your take on Mr. Ueda yourself, because it's, the market's still kind of guessing whether he's going to be a hawk or a dove, and what this post-Kuroda BOJ is going to look like.
Right. I think it's very simple. And full disclosure, he's a friend. He was one of my teachers. The key thing is that he is completely objective. He's a scientist. He's an economist. He's not dogmatic. He was the teacher to everybody who is anybody here in Japan. And from that perspective, it's going to be a very thoughtful Bank of Japan. There is no rush to do anything. He's not out for a quick win. He's going to look and study and then propose what the new operating mechanism is going to be like. So if you're in a hurry, Ueda Sensei is not your guy. He's the guy who's going to steer Japan into a more predictable and pragmatic future.
Okay, so Jesper, what would that future look like then? That's the big question.
No, I think it's very straightforward, and it comes down to the economic fundamentals. And what you are seeing is a little bit of sign of demand pull inflation starting to come through in the domestic service sector. You're starting to see wage growth. Nominal income is accelerating very nicely. So if you ask me for investment advice, I predict that in 12 months' time, the 10-year bond yield is going to be around 1.75 to 2%.
And just given the fact that he's an academic, Jesper, is he going to be a little bit more, focused on the data and more data dependent? Because if you take a look at inflation in Japan, it's already reached 4%. Can the BOJ really not rush to do anything?
Yeah, but look, it's not about inflation as the one data point, right? The key question is, the overall environment. You can look at nominal GDP, which is something that, many academics look at very carefully. You need to look at the bank lending data to actually see, what your colleague pointed out further is that, the yield curve is going to be steepening, which allows the banks to make more money, but are they going to make more loans? So the credit multiplier actually keeping in function while you're normalizing Japanese interest rates, that's something that you want to be watching out very careful. In many ways, the CPI is just chatter that you like to talk about. The belly of the beast is much, much more complicated, and re-liquefying the domestic lending market, that's going to be a big focus.
Jesper, you mentioned at the top of this interview that he is a friend of yours. I need to ask you, have you spoken with him since news broke on Friday, and do you get a sense that he'll accept this position?
No, look, the answer is no, I have not, but I think that it's extremely unlikely. You remember last Monday, there was this leak that supposedly the current deputy governor, Amamiya, was going to take the job. That was, turned out to be completely wrong. Prime Minister Kishida himself has, spoken about Ueda, in a very positive way. And I think, it's 99.99999% that Ueda is going to be the next governor.
Okay. I will know maybe 24 hours from now, Jesper. I'm just wondering, in terms of what this means for risk assets, everyone thinks, if the BOJ turns a little bit, even just marginally more hawkish this year, risk aversion will continue for 2023. How do you see it in the Japanese market playing out?
It's very interesting. I think that, the interplay, this is really where foreign exchange comes in, right? If you do end up with dollar-yen strengthening back to the sort of 100, 110 range, that's tolerable but painful for the industrial sector. So I'd be very, very mindful, of sort of looking at the Japanese exporters with too bright a light here. Conversely, I do think that Japan's financial institutions are going to be doing well. And the one thing, Yvonne, that you got to also keep in mind, I think figuring out what they will do to the long end of the curve, I think is relatively easy. They will follow the path set by Kuroda and increase the cap. But the real question, and where risk assets are really going to take it on the chin, is dealing with short-term interest rates. Because as you know, it's still negative short-term interest rates. Once you start to change that, the entire risk pricing model begins to flip. So that's going to be a bigger and bigger question. And quite frankly, I don't really have an answer to that.